it basically sat. And then you got the announcement, and the markets got exactly what they basically were looking for, which is to feel seen. The Fed told them all the things. Sentiment is down, and tariffs typically do this and that to growth and inflation, as you all are concerned about. But it's soft data, and until it's hard data, we're not going to change things, but don't worry, we're on the case. We're paying attention. So the markets liked it, bonds liked it, dollar didn't like it, all the things you might expect. But we're still in that same range. So until you get some kind of conviction here, there doesn't seem to be really much to do in any of the major assets. I mean, I'm sitting long bonds because they haven't overturned their.
Well, don't go there yet. We're talking
higher.
Stocks still. We're still talking stocks.
All of them. All of them.
What are you doing?
Name all the charts.
You don't want to go to bonds yet?
They all look the same. It's all the same.
We still have 51 minutes, Ilya. You can't do that. Okay. Mike, jump in and save this.
I'm obviously not annoyed by the lack of progress in the bonds and the dollar.
Before we go into single equity names here, which it's kind of a mixed bag. Microsoft's off a little, Nvidia's up a little. Sector rotation isn't great. What do you think of the indexes down here, this recovery after our 10% correction in ES and NQ?
I was sad this morning when I saw we were down pretty big, and then I was smiling when we weren't. I think really it's I think there's a couple of things that are interesting. I mean, you see volatility coming in. Even though we're down today, I think volatility is coming in just because the range is a lot smaller than what we've seen in recent times. But, I mean, the market's trying to recover as best it can, but I think there's still a lot of questions under the hood. Powell was wearing a purple tie, which usually means buy, buy, buy.
Yes.
But, there's still heightened implied volatility with the VIX at 20. But we are creeping out of backwardation in the J, K, and M contracts. So I don't know. Usually, obviously, backwardation tells us that we should expect big, violent moves in either direction, which we've gotten. And contango tells us that historically the markets have slowly grinded higher. But whether we see like a huge V bottom versus because that's what we are used to. I feel like the last couple of years we see big sell-offs, we see big buys that are completely reversed in a couple of weeks. I'm not sure that's going to happen this time around, but with that said, there's a lot of big name tech stocks and big components of the S&P and NASDAQ that have been absolutely destroyed. And I think if there is a investor out there that's looking to buy something, the whole board is open. If you're trying to, make 20% or 30% from the lows, a lot of these single name stocks are there. So it's going to be interesting to see the rest of the summer, I guess, into the summer months. But NVIDIA trying to climb higher. Micron had earnings after the close. They're up $5, $6. So the tech stocks are not dead yet. Not dead yet. We'll leave it at that.
Not dead yet. That is
an encouraging assessment.
Mike, when you're down 90%, you can still drop another 100%, right?
Correct.
It's way about.
Yeah. Yeah.
Okay. So, what do we do here though with a company like NVIDIA? They had a pretty interesting news announcement today. They're opening up a quantum computing research lab outside of Boston, which Boston is a major research hub. That's obviously more important than the news that the Celtics were sold today. Who cares about Boston sports teams? So NVIDIA gets a nice little counter trend bounce. The market's down, but NVIDIA's up 0.86%. It's not like that resiliency really is going to reward us. I mean, there's a 22.3 IVR, Mike. Do you just move on from NVIDIA at the moment? Or because this has been one of the champions, do you have to put your faith in it and continue to trade around short put spreads, long call spreads, et cetera?
Yeah, I like when IV's low. I think we kind of lean more towards diagonal spreads, calendar spreads. NVIDIA, I think, is the poster child of that. I mean, at the same time, IV ranks at 22, but the actual implied volatility is still in the 50s. With that said, IV rank being low tells you that this is still a cheaper diagonal spread than what it was before. And you're getting $118 stock price versus $150 back at highs. So yeah, I think if you're bullish, or even if you're more neutral to bullish, you can still set up a trade where you're long May or even long June. That's what I got. That's what I did in Micron today. I actually bought the June contract because the implied volatility differential was pretty strong in terms of the May contract still had a much higher implied volatility than June. So I didn't have to pay that much more to get almost 50 more days on that contract. So I think that's getting kind of interesting. If you're longer term bullish on these tech stocks, getting into the June cycle and selling April, I think is an interesting setup because that also gives you the embedded roll where if you're wrong and the markets keep chopping around, you can roll from April into May and still have a nice distance between your long and short option, which is key for getting profitability out of that if there is a directional move. But I'm encouraged with Micron rallying. I think if that holds, you might see a sympathy rally in NVIDIA and some of these other tech stocks. But yeah, I think defined risk for me is the way I'm going, unless I'm really taking a stab and I'm comfortable with taking the shares at certain levels. Or if I'm trading QQQ straight up, I think undefined risk in there is a lot easier to manage and deal with just because on the worst days, it's just a normal day in an equity. So that's kind of where I'm at. But I like trying to catch these dips. Unfortunately, I was a little early for a lot of these, but I still traded very small and I can dive in with another bullet here. But that's kind of how I'm attacking these is your Microsofts, your Amazons, your Apples, like all these stocks are at 28, 30% IV. But if we rally 300 points in the E-minis as kind of a relief, you could see these stocks go up significantly, well outside of the implied volatility, I guess is the best way to put it. So long-winded way of saying diagonal spreads and calendar spreads are where I like to live with it, especially at this point in time where we're kind of flattening out here. Even if we move lower, you can still get a longer term trade on.
Ilya, I think the lack of follow through is perhaps alarming to some, maybe not so alarming to others. I think about the S&P 500. You were talking about a bit of chop right now. It really seems like there are two clear paths forward from here. Either this is coming together as an inverse head and shoulders pattern, which if a neckline comes in around 57.75, that gives you a pretty beautiful measured move off the low back close to 59.90. And if you believe it, lows that you have after DeepSeek Monday, what do we see here? Tariff Monday in early February. The lows are basically there. That'd be returning to the neckline of the double top high to a certain extent. The other scenario is that this is simply a triangle. And if you begin to fail below today's swing lows, below 56.80, you start to look at the 56.50 area and then the lows from the month, lows from the year. So right now, I don't know. I mean, I have a short put spread on still, and I'm comfortable holding it because I put it on last Friday and we've weathered the big event risk so far. But I can't help but think that for people who are looking to outlay capital right now, this is actually a decent time to just wait maybe a few days longer. You know, maybe it's tomorrow afternoon, maybe it's Tuesday, who knows? But there could be a directional cue coming up sometime soon that will give us a little bit more confidence about which way the next, 200 points are going to be.
Absolutely. And I think the way that this sets up is, in my mind, kind of the news flow is probably more supportive of a larger correction than it is of an immediate sell-off. Because basically everything we heard from Powell at this press conference after the Fed was, look, we're attentive, we're paying attention, but we need to see this in hard data. Well, what's the hard data? The PCE number is really well telegraphed because once CPI and PPI are out, those numbers rarely surprise. Maybe we'll see something there, but that seems unlikely. That comes out at the end of this month, I think the 28th. Then there is this Monday, the PMIs. Now, the PMIs are still survey data, but if they're really, really scary, again, for a third month, then the markets are going to start to really notice. So maybe that's a block if it misses. We'll see. The real hard data that we have to look at next is NFP, and that's the first week of April. So there's all kinds of time here. Now, if the markets wanted to entertain an idea that everything is fine because the Fed has their back, which was their initial reaction after the policy announcement, they heard Powell and they're like, yeah, okay, so you're slowing down QT, telling us it's nothing, but you're doing it. You're telling us that you are going to end QT a little bit above where you think the assets on the balance sheet are ample. In other words, you're biased to be a little bit on the looser side when you end QT. You don't know how things are going to work out, but you're telling us that you're prepared to act quickly in either direction. So you're not going to shy away from cutting. You're calling the current setting of monetary policy clearly restrictive. So you're biased to cutting. Okay. We have some open space for the market to go, oh, right, this is fine. Let's just go to easy money sentiment melt up. Bonds go up, dollar goes down, stocks go up. So in my mind, that's kind of the path of least resistance for 2 weeks' time, but maybe we have to get through whatever Opex shenanigans tomorrow to get that clarity. Having said that, I am biased short because I think the trend is down. And so I'm flat. I would rather be a seller around those former range bottom support become resistance, obviously. But if it breaks the counter trend line there, that orange one, then I'm in. Let's go. I am also completely open-minded to getting long if we take out this range and writing out something small, maybe in, to manage size in like a SPY vertical or something like that. Maybe an IWM vertical for Russell. NASDAQ seems a little funky, but we'll see if the Qs offer something. At this point, I think Russell actually seems like it's held up the best. So maybe that's where it is. But I'm not opposed to a counter trend move if the risk reward is there. So far, it's not.
It doesn't seem like it's there right now. Not coming together in the S&P, in the NASDAQ. Similar type of setup. I've drawn it a little bit differently. You have a trend line, maybe a horizontal level of resistance overhead near 20,150, 20,250, somewhere in that band. But if you're not clearing there, then this just looks like a bear flag. And ultimately, that's the problem when I was reflecting on this today with Westwater a little bit and kind of hit me. One of the reasons that I've been so bullish on the market for the past few years is because you and I started working here in full-time in December 22, Ilya. The market bottoms then. So it's been a straight line up up until the last month. It's been a straight line up. But I'm reminded of the conversation that we had so many times over those months. If it looks like a head and shoulders pattern, do you trade it short? Not until the neckline breaks. Right. So if you're looking at this, if this is an inverse head and shoulders,
that was my whole year last year. That was my whole year last year. Looking for those breaks, and then when they don't happen, going, well, it's a good thing I waited for the neckline break. Next.
Yeah, and so this being a down market, it kind of is the exact opposite logic applies, or the same logic, just crisscrossed. So we see that then you don't trade this as an inverse head and shoulders pattern unless you're breaking the neckline as well. If you want to treat it as a flag, right? And that's kind of the game right now. You could see a credible case for a bottom having come together here, though. If we do, I'm just looking for a little bit more of an advance, guys. But if we get a little bit more of an advance here, the downside obviously has been broken. We're moving out, a swing through 20,150 going into next week. That's something maybe we can hang our hat on. Yeah. But Mike, you're more of a quant guy than Ilya and I are. I'm more of an options person, and I think that you would be a better person to explain what you're thinking about, or what we are the collective thinking about on overtime with respect to Opex tomorrow. $4.5 trillion notional value set to expire. I think one of the curiosities of the last Opex in February was that it occurred on the same day as the S&P Global PMIs were released. So you had this like accelerant as people were rolling their positions, and they had a reason to just step back for a little while. What do you think about tomorrow's Opex? What do you think about this week's expiration? Are these things that traders should be concerning themselves with if they're operating by the typical 45 and 21 day out tasty cycle?
Historically, they've been interesting. I believe the research team has shown that the witching days are traditionally lean bullish, but I feel like we're in a weird time where that may not be the case, of course. With that said, there's still a pretty hefty, like today was a day where it felt like, okay, we're not moving anywhere. We're just digesting, like you mentioned. But tomorrow, there's still a 50-point expected move in either direction based on SPX implied volatility. And if you extrapolate that to through next Friday, there's only a 120-point expected move. So definitely leaning into implied volatility tomorrow could be due to that. But yeah, I think if we're going to see some kind of move, I think tomorrow is interesting because there's such uncertainty with where we're at right now. I think you might see kind of a snowball effect where if we start to see a 30, 40 point move to the upside, maybe that extends to a 50, 60, 70 point move to the upside and vice versa to the downside. I think you might see people waiting to see what happens and then just piling on to that directional move.
Ilya, do you have any strong feelings about Opex this week? Are you I remember on Friday, February 21st, I said, it's Opex week, and so this move lower, maybe it's because of Opex. And you're like, I think it's a little bit more than Opex, Chris. Like, this is the S&P Global PMI.
Yeah.
Tomorrow, we don't have a catalyst like that on the calendar.
That's right.
Does that reduce, do you think, the potential of seeing a market go haywire because there's nothing really to exacerbate this extreme amount of flows and position flipping?
I mean, to me, whatever spring has gotten coiled from CPI and through the Fed, I mean, that we've had a lot of event risk. That spring has not uncoiled. And maybe it hasn't uncoiled because the Fed isn't sure and the markets are unsure. And what Powell did at the podium yesterday was basically commiserate. He was getting asked all these questions like, but what if this happens? What if that happens? And all of his press conference was like, guys, we don't know. You don't know. We don't know. Nobody knows. Let's all hold hands together and be ready to cut rates if we know when we know. Who's to say? And that was the whole press conference. I think that ultimately that's sort of what the markets liked about it was Powell kind of leaned on the podium, looked the markets in the eye and went, I know. Who's to say? You don't know what we're doing. We don't know what we're doing. Nobody knows what anybody's doing. Take it easy. We'll be with you. We're watching. So the market is waiting to unclench and pick a direction. If Opex is the reason, if they need to be shuffling through positions before there is this unclenching, that wouldn't surprise me, right? It wouldn't surprise me if people say, you know what, that's a lot that we just heard. Let's digest it, but then let's wait to kind of clear the books, and then we'll lay out capital based on whatever kind of the 1 week, 2 week view is. I can see that. Markets oftentimes wait for event risk before committing, even though they might know which way they want to commit. They will often wait for event risk just to get it out of the way. And so I can see Opex being that kind of a thing where it's not necessarily the nature of the thing. It's just let's get through this, and it will be more significant in its passing than its substance.
Yeah, I mean, you can see the market grappling in real time with the two narratives. Is it good that the Fed doesn't need to give us an emergency rate cut? Sure. That's good. Right?
I suppose.
Right? Is it bad that they can't do anything at all because they don't know which way up is from down? They can't see through the fog of the trade war. That's not good, right? You run the risk of falling behind. I mentioned before, and Ilya, you tried to do it 28 minutes ago, but we'll talk about bonds now. We'll go over to ZB and we'll look at the price action today, where after the Fed meeting, you get this explosion to the upside and pullback. And I couldn't help but be reminded of what happened in ZB back here in January into February 2024. We had a Fed meeting where the Fed told us they were going to stay on hold, and people were expecting that maybe, just maybe, they were going to start talking about when the cuts would begin to materialize, and they didn't. And bonds surprisingly traded to the upside. And I remember specifically you, me, and Dylan having a conversation on February 1st, and my exact remark was, this is the market saying the Fed's going to make a policy mistake. Now, granted, that didn't stick around, so maybe it was the wrong interpretation, but in that immediate aftermath of the Fed, bonds raced higher, despite the Fed telling us that, no, we can't do much of anything at all. And then sure enough, what happens? We give it all back immediately.
Yeah.
It kind of feels similar in that regard. It's obviously not the same thing when we think about what the Fed's doing, and we want to go this way on the chart. It's obviously not the same thing. It's a completely different context. We're not worried about inflation. We're worried about growth. But this lack of stickiness after the Fed meeting does raise an eyebrow. I do find it concerning. I know I'm in the same boat as you. We're both long bonds, notes in some capacity, various forms and functions. But this is a really ugly candle.
It's annoying, is what it is. Because earlier today, when I woke up this morning, I was like, well, the dollar is pulling back a little bit, but it's not, or pulling up a little bit. It's not clearing any crazy barriers, so I'm okay there. But look at ZB, look at my boy go, no, it did not stick. But at the same time, it also didn't come undone either. So it's holding that range that we've been seeing. I mean, as a fan of horizontal lines, I'm sure you can guess where my line is here, and you can see it's kind of clawing its way up. It's kind of trying to take out the internal range. It isn't sticking the rally, but it right there, of course. But it's also not coming back in. And so I think this is just wait and see now. I think the market has picked a direction. I think it knows where it wants to go. It's no surprise, by the way. And it's very interesting that the rally in the bonds happens immediately at the Asia Open after the Fed. So markets outside the U.S., they run the bonds up all night. They run them up in Asia. They run them up in Europe. It's only really once the U.S. enters the fray that things get beaten back. And maybe that's Opex, because obviously that's not a thing for markets outside of the U.S. necessarily. So when I look at this, I go, okay, well, Wall Street didn't like it, but maybe that's idiosyncratic. Sentiment-wise, the markets seem to want the bonds higher. The Fed sounds dovish. They just don't want to make a mistake, to your point. So they're being careful. They're saying, we're not in a hurry. We'll give you this forecast that points in opposite directions, but that's where we are. It's kind of a scratch. We don't know. So when you sort of boil it all down to what happens, yeah, okay, maybe they cut sooner, maybe they cut later at the front end, but at the long end, you have a tilt in your direction here. Because if they cut sooner, the entire curve shifts, and the long end will capture that.
If they cut, something bad happened, and the market flees to safety.
That's right. And if they cut later, that means the market is going to go, okay, you all are asleep at the wheel again, so what we're going to do is put all kinds of easing in the back of the curve. Because since you're going to be late, And since you're going to be reactive, you're going to have to go harder and faster when you do go, because you're going to be doing some sort of a catch up. So I think the long end still looks okay. I'm fine there.
Mike, do you have any bond positions? Do you find this conversation anything interesting to how you trade and approach markets?
I tried to get long TLT, and then my position expired, and it expired right around when it rallied almost 10 points from 85. So it's not fun for me, but I usually like to trade rates directly. So like 2YY, 10Y. I used to trade those a lot more frequently, but I was looking at those just now, and I was wondering if you guys had any take on the fact that the 2-year sold off almost 2% today, but the 10-year was pretty much flat. And I'm looking at the FedWatch tool for probabilities of interest rate cuts, and it kind of definitely aligns with what Ilya is saying, in the sense that if you look at further or longer term probabilities, there's a strong lean towards 50 basis point, 75 basis point cut by December. But there's still a lot of uncertainty. If you look at the May cycle, there's a 20% chance we get a 25 basis point cut. But in June, there's a 60% chance that we arrive there. So still some near-term uncertainty, but it's being priced into that longer tail. But what do you guys think of the direct rates movement today, with the 2-year kind of getting crushed where the 10-year is flat?
Not a great sign if you think that the Fed is, well, it says higher for longer, right? I mean, like that is the policy mistake twist in the curve. When short end rates get pinned up and long end rates begin to drop, the market is saying that there's either a near-term inflation problem or the Fed is missing the mark and they're going to have to play catch up later on. So inversion, and again, it's always contextual. Why was this inversion not a big deal in 2022 or 2023 in terms of like this means they're going to have to play catch up? Well, they were intentionally kind of fixing the yield curve that way. They wanted to raise borrowing costs. They wanted to try to crimp down aggregate demand to stamp out the inflation. But the context here is not about inflation. I mean, Powell himself, and we go back and forth, are tariffs a consistent price rise? Or are they a one-off price rise? Either way, we agree prices are going up. The Fed's perspective, according to their literature, Powell hinted at this as much yesterday, they see that prices are a one-off hike. So if inflation's increasing by 2% and you get a tariff, it bumps up to a new plane and then it continues increasing at that 2% clip. And so should the Fed act on that? No, not if it's a one-off. Why? Because while there's a one-off bump to prices, there's also a permanent decrease in real economic output. There is a loss of jobs. This is what the history tells us. This is what the Fed's modeling shows. And so the Fed says, no, we shouldn't even think about inflation. That's transitory. Great word, Powell. That's worked out well in the past.
Why he decided, of all things,
of all the words
go
to
to
say,
that word. There are so many synonyms. And he is so well-spoken usually. Why he decided to go for a word with that much baggage. Come on, man.
At least he's making
I'm trying to be a Fed apologist out here. Help me out.
Mike, when you heard him say transitory yesterday, did that like raise your eyebrows? Like, we've heard you say that before. Yeah,
I always find his pressers amusing. It reminds me of like when me and Nick banter, where I say, XYZ stock is, well, I can't say XYZ anymore. Sorry.
That's Square.
Yeah. Nike earnings are announcing after the close. It's not going to stay here. It's either going to go up or go down. Like that was what I was hearing yesterday, where it was like the landscape is starting to paint itself in terms of the picture that we have and the process that we have, but we just don't know what it looks like yet. So stay tuned. It's just like, at least I'm not addressing the globe, I'm addressing our loyal tasty livers. But it's amusing to me when he's just getting barraged with questions and he has to just tiptoe around every single answer. But that's, that just speaks to the time we're in. But yeah, better word choices are always available, I think.
My favorite Powell-ism, for what it's worth, is that we will know the neutral rate by its works.
Oh, this is a good question for the chat. What's your favorite transitory synonym? What should Powell have used instead? Yeah. Impermanent, temporary, transient, brief, short-lived, ephemeral, evanescent, right? Fugitive. That'd been great. He's like, yeah, this inflation's a real fugitive. Like, we're not worried about it. Like, what? What are you talking about, man? It's like
the algos would have broken on that one.
600 ES points, right? Like that, like God.
Yeah.
Done. Circuit breakers kick in.
Yeah.
We were talking about sector rotation earlier here. Let's go into the details. It's not a great look today. We track those 25 different sector ETFs here on Overtime. I'm only counting 6 that are in the green. And what's in the green? Stalwart XLU, IYE, XLE, OIH, XLF, XLV. That seems pretty defensive. And then on the flip side, the worst performers among them, biotech, technology, retail, banks. So not exactly the friendliest mix. We had 2 consecutive 90% issue up days in the S&P 500, which off the lows, when we've seen that occur with right at the 6-month low, historically speaking, it's about a month of chop, 3 months, 9 months, 12 months later, you're looking for higher returns. I don't know if there's enough here yet to justify doing it unless we can see it getting big long, right? Like, I want to be long out of the money calls. This thing's still going up. Let's get them cheap. Let's get some convexity in the position. That's not my mindset. It's more like, let's just nibble here. Let's nibble right now before we see that upside convexity. Mike, I want to hone in on what you were talking about, though. Some of the big names being down like 20%. I know this is a really interesting stock, right? It feels like it's so detached from fundamentals, but Tesla's always been detached from fundamentals. It's largely moves on people's faith in Musk executing this pie in the sky idea. And that's not a knock on him, right? He had a vision. He sold it to the world, and people got rewarded for it because he hit all these goals. That's why
and pie in the sky ideas are kind of his thing.
Well, and you know what? Years ago, when there was deliberations over his compensation package, we were talking about it with Vic Ilya, and I said I take particular issue that they try to strip him of his compensation package.
I agree.
Right? So on the merits, on the principle of it, you have a signed contract.
Man's doing his thing. You sign a contract with him, give him his money.
Give him his money, pay him. But so Tesla has always been a stock that's been tied to Musk's popularity in some form or fashion. I know that Dylan's been trying to sell some put spreads down here. I know that Tom has. I think that Tony has as well. How are you looking at this right now? Is Tesla cheap at 236? Should it be back at 450? Is this a good place to try to get some long delta? I mean, the stock's down 50%. If you liked it at 400, you'd probably love it at 236, Mike, right? Why not now, if not now?
Yeah, Tesla is the Fast Times at Ridgemont High in VHS form. It is a cult classic. Like it doesn't, like, they don't
Solid
need
reference.
to actually sell cars. Like this stock, like you're saying, is like, it's the belief that they can do things better than anyone else, and it's like high technology, high futuristic stuff. But yeah, to answer your question, I mean, if you liked it at 300, why would you not like it at 240? I think there's a couple things that are interesting. I mean, it bottomed out in October of last year, right around the same level.
Right.
And it had that rally all the way up to 440, 460. But that, I think, was just another example of post-Trump euphoria. Like, if you look at the election, the day after the election, it went from 220 to 260, and it just never looked back. And now it's come crashing all the way back down. But yeah, there's plenty of premium in here. Nick and I actually both placed bullish trades in here today. So Nick did a call crab trade, which is basically a butterfly where you're pushing the long option further out in time. And
Okay.
he did that. Let's see. He bought the 250 call in May, and then sold the 275 call twice, and then bought the 300 once in the April contract. So again, it's just an equidistant butterfly, but you're pushing the closer long option out in time. That was a $1,200 trade. Nice max profit there. I actually did a much smaller trade. I bought the May 300 call and I sold the April 300 call against it. So I just did a straight up calendar spread. These higher price stocks, I think with high implied volatility, they can still perform well if you get that rally. And mine was only a $500 trade. So the nice thing about this setup, if you're buying May and you're selling April, is that the April monthly contract will expire right before the projected earnings. So worst comes to worst, if you have to roll this, you can literally roll it 1 week out and get a ton of earnings premium in there and further reduce cost basis. So that's how I'm playing it. Just keeping it small and defined risk in here because, it's gone from 400 to 200. There's nothing that says it can't go from 200 to 100 or from 200 to 300 in like a span of 2 weeks. So defined risk in here, I think, is the way to go, even if you have a large account.
Take a look at where that top in Tesla is, because there's it's an interesting index from cargurus.com, which tracks the average resale price of a used Cybertruck. And it's interesting to see what has happened. It initially spiked higher, but has since absolutely cratered. And if you look at what's been going on here, the benchmark, the Car Gurus used car index, down 2.79% year over year and down 1% over the past 90 days. Cybertruck down 57% year on year and 11.4% in the past 90 days. So not great. Sentiment, if you wanted to kind of look at this as a barometer of, are people buying the futuristic visionary that is that Tesla is an avatar for? Doesn't seem like there's a lot of confidence. Seems like the market is flush with used Cybertrucks and their prices are caving.
So we'll always start with this point, like violent protests, the looting, the burning of the Teslas. Like, what are you guys doing? But clowning yourselves. First and foremost, every major theorist that talks about nonviolent protest and civil disobedience does it in a way where gains are maximized through the nonviolent aspect of the protest. So if you're trying to make a point, hold up signs, honk when people drive by, stop with what delegitimizes the movement. Whatever you're trying to accomplish. What does it do to
vandalize a Tesla to make your point? Stop it.
I don't get it. Well, as someone who's now in the car market, Ilya, some of these prices are looking pretty good, right?
Like my friends are looking at all of this and going, I tell you what all of it means. I'm no market person, but there's about to be a lot of cheap Teslas on this market, and I'm about to go get me a bargain.
Yes, that does seem to be the case, but there's also like, I'm trying to figure out how I fit the recent commentary from the White House in my, pantheon or parthenon of when people with their hands on the economic levers of society tell you to do something, you should probably do it. Like when Besson and Trump have been saying, we don't care about stock prices, we want lower yields. You go, all right, there's no put in the stock market right now. They're not going to stop this thing from falling. And when Obama says in March 2009, it's a good time to buy stocks, like the government is flooding the market with stimulus. You listen to those big macro calls. I think you listen to the big macro calls. I find it really curious. And do I take issue with there being a Tesla event at the White House? Not necessarily. Biden had, the F-150 electric truck there.
Sure.
He wasn't doing a sales pitch for Ford. That crosses a line. But then you had Letnick out yesterday saying that this is a generational buying opportunity for people to buy Tesla. People should be buying Tesla. What are you doing? There's part of me that says, okay, the people with their hands on the economic levers, they're in on this. That's a signal into itself. So then there's also the part of me that this is a single stock, so it doesn't fit with a macro call.
No.
And if these people are out there saying these things, and given what we know about publicly available data of Tesla sales in places like Germany and France and the UK and Korea and Japan, right? Like anywhere in the world, effectively, it's been plunging double digits and then some. Mm-hmm. I think there may be I'm not the only one who thinks this. It's not an original thought, but like there probably is a really bad quarter of earnings coming down the pipeline for Tesla, right? Mike, I'm thinking about your trade here where you say if you have to run into an issue, like this is 28 days to expiration, so maybe you try to ride it past 21 a little bit before you roll it up past the earnings. But if this stays juicy, that becomes really, really compelling. I suppose the question we're going to ask ourselves is, if all this information is already public and we all know these things about what's been done to Tesla's brand, how much more downside is there? Is this like the non-farm payrolls report a few weeks ago, where there were whispers of a negative number, and the fact that it wasn't negative, even though it missed, it's kind of like, oh, fine, we're not dipping into imminent recession. Okay, we can stop falling now. Right? Like Tesla may have a bad quarter, but so what? The stock's down 50% from the highs. That's largely priced in. So if there is a negative reaction in the share price, as the trader in me says that is a dip that we've absolutely got to fade, Mike, and we've got to get some long deltas against it. The volatility is there in 36 days. The signals, the writings on the wall, a washout could really be a gift. And that could actually be the final clearing of the deck for the NASDAQ, where Tesla being such a large component, it takes that final leg lower. Then we're able to base out in the broader index, and we can begin our new rally to the upside. I don't know. I sound crazy. 40 chess, if you will. But I'm trying to figure out, like, I'm trying to think of the narrative here. What hasn't been priced in that we already don't know? There are literal news reports of Tesla's on fire because of people throwing Molotov cocktails at them. Yeah, we get it. The brand's in shambles. What else is there to know about it right now? Right? This feels like a sentiment extreme. It feels like a sentiment extreme.
Yeah. Nick had a great one-liner today. He said, Tesla is at peak blah. That's literally what he said. Okay. But yeah, I agree. I think like when you look at, and especially the diagonal trades, that's why I think a diagonal spread or calendar spread in here is the way to play this, is because like you said, implied volatility, if you just look at the difference between the price of the 28-day and the 36-day 300 strike call, the 28-day is trading for 224. 1 week later, it's trading for 430, 420. So it's twice the amount 1 week out. That bakes in the earnings premium. But if you're buying May, that has that inflated earnings premium and will still have inflated earnings premium when the April expires, you kind of have this beautiful thing where you can buy the inflated premium that isn't going to decay as much. You sell the premium that is before the announcement that's going to fully decay, and then you can roll into the 36-day from the 28-day and pick up another $2 or so to further reduce basis. And then you could even, like I have a calendar spread on at 300. If we get a rally and I want to keep the trade on, I could buy back the 300 in April and roll it to the 320 or the 330 1 week out and do it for a credit. So that's the kind of flexibility you have when you diagonalize these trades, where your long option is past the earnings cycle and your initial short option is before it. So I like the way it sets up. I agree with Nick. I think we're at peak blah. And I mean, I don't see this stock going to zero. I mean, in theory, I guess it could, but I think it's just going to behave like it always has, where it's just this very volatile, very sentiment-driven product, regardless of what their actual earnings numbers are. Even if they miss, like we used to live in a world where we were expecting $3 or $4 EPS misses, and they would post like a $2 miss, and the stock would be up $100. So like I think this is just one of those products that will ebb and flow with the cult and market sentiment.
When you say things like that, I'm reminded of the Andy Dwyer. Is it Andy Dwyer? No, I'm thinking of Andy from The Office. Yeah, Andy from The Office. He's like, the thing about good times, like no one ever lets you know when you're in them and you only know it afterwards. Like, remember how like those are such fun trading times. Like, oh yeah, Tesla missed earnings, stock's up 20% after hours. Like, of course it is. Like, let's just keep buying the calls. You don't need to think. And those are fun things to do. And as the inimitable George Soros would say, like, when I see a bubble forming, I rush to buy in and add fuel to the fire, right? And like that's in those market environments, that's what you have to do. It's the only rational behavior is to trade like a lunatic and seize the day. I'm not a great scalper, so maybe put an asterisk on that. But when the volatility is here, you have to capitalize. It's a 58.9 IVR in Tesla right now. That's certainly in excess of the broader market, which is 33.5. Guys, we've talked a lot about stocks, single stocks. We've talked a bit about the Fed here. We haven't talked about my favorite asset in the world now because it just continues to chug to the upside. Gold, new, technically a new closing high here in GCJ5, although not the absolute high. Silver prices pull back modestly down by 0.29%. Copper prices, they're up by 0.23%. The metals continue to run right now. Ilya, when does it stop?
So we're talking with Westwater about copper in particular yesterday, and the upshot was that Westwater is bullish because he sees structural forces here. I'm a little bit suspicious, not because I don't think that what he's talking about structurally isn't right or doesn't make sense. It almost certainly does, and Westwater knows more about the inner workings of this than I could even begin to. But when I look at what's going on in China, I see some interesting dynamics. If you take a look at what's going on in China, of course, the world's largest buyer of copper. If you look at what's going on in ASHR, the mainland ETF, it's down. And it's down back into its range and never really had that rally that everybody was singing songs about when they looked at something like FXI, which of course is different than this because all of those names are securitized and traded in Hong Kong. And Hong Kong markets and mainland markets are not the same. They're disconnected. And what you've seen is Hong Kong markets have rallied. So if you look at FXI, you see that. And when you look at this, they haven't. Underlying this are capital flows that have, in a one-sided way, flown southbound. That is, from mainland to Hong Kong. There's data on this from the Shanghai and the Shenzhen Stock Connects, and you can see it. At the same time, more and more people in China seem to be turning defensive on their spending. The spread between how much new money is going into demand deposits, so checking accounts type things that are there to spend readily, versus time deposits, so like CDs where you lock up your money and you will wait because you're not planning to spend it. The ratio has gone to like 3-to-1 in favor of time deposits, which is the highest it's been at least since 2008, higher in fact than 2008. So people don't want to spend money. The stimulus in China isn't working. All of what they keep saying is at this point just rhetoric. And so I look at copper as it sits at major resistance and go, well, how long before the market looks at China and goes, what we've been seeing in Hong Kong is money leaving the country because it needs an out and there's capital controls. So people are just buying stocks in Hong Kong so that they can quietly later cash out and send the money abroad. Or even if you just look at the dynamics in both of these markets, you can, I think, very clearly see even Hong Kong is getting soggy. So how long before the markets go, they whiffed stimulus again? There is no uptick in Chinese growth that's coming downwind. They're still not serious. And this thing comes undone. So I see it at resistance, and it worries me.
Mike, do you have any strong opinions on gold, silver, as we look to wind down this week on overtime?
I was peer pressured into placing a bearish position in gold today. I really like broken wing butterflies in here in the futures. So gold futures, like doing it to the downside if you're trying to play for a pullback, or to the upside as well. The one I had on was a 2920, 2930, 2940. That's what I have now. But I had a call broken wing butterfly. I got one day where it dropped and I bought in the risk. So that's the nice thing about broken wing butterflies is if you get the out of the money move, you can remove the risk, free up the buying power, and leave yourself with a symmetrical butterfly on for a credit. But today I placed a bearish trade in GLD, just a really small diagonal spread. I bought the 280 put in May and I sold the 275 in April against it for $375. And I'm literally just looking for one day of a pullback and I'll close that for $100. But yeah, I mean, it's pretty wild to see a 16% IV product just go straight up like it's an equity. But this is where we're at.
When I see where we are in the chart, there's two ways to examine it. This seems like a place where the market could really cool off, right? Let's take that into consideration. Fibonacci extension, those June lows, the highs that we have in October to the November swing low. First target would be right around 30.43, 30.40, 30.39, depending upon your exact measurement and what product you're using, right? If you go out to a different expiration like GCM5, different levels. The other one here is the near-term triangle that we just saw form over the past month and a half in January through the swing low in February, and that gives you a target of about 30.60. Today, the high was 30.65.20, where 5%. We're getting 5% away from our 1 month moving average. It's getting into the froth zone right now. So I'm remaining long gold, silver, but I understand that there may be a wallop coming, which is why my priority at the end of this week is to roll out, get more duration, and that longer term chart is where my personal Valhalla waits. On a pullback, I'm structuring trades for a move up into 32.25 moving forward. Silver for $40 an ounce. So we're going to have some fun here next week, though, because overtime is out of time for today and this week. I want to thank Mike Butler for coming aboard. Same thing for Nick Batista to fill in for Dylan Radigan. Likewise, Thomas Westwater for me yesterday. We'll be back on Monday, same time, same place, right after last call, 4 p.m. Eastern, 3 Central. So for Ilya Spivak in San Francisco, Mike Butler in Chicago, I've been Chris Vecchio in New York. Good luck trading. After this, Tasty at Night begins. You know who's starting it. It's Ilya Spivak with Macro Money.
See you there, everybody.
Well, this is me. Thank you so much for tonight. I've never been to the Hard Rock Cafe before. That was really fun.
Bow, bow.
Okay, well,
This is a song for the broken hearted. Bow, bow.
Okay.
Hey.
All right.
Why don't we get up there and you can lay some hands on me and I'll see if you're slippery when wet.
That's really inappropriate for a second.
I want to lay you down on a bed of roses and send you off to Slumber Town in a blaze of glory.
No, don't say things like that because my boyfriend was an aerial artist and he used to do things like that.
I might be Monday now, but someday I'll be Saturday night. You give life a bad name. Whoa, shake it up just like bad medicine. Bad medicine is what I need. I'm going out in a blaze of glory. Take me now, but know the truth. 'Cause I'm going out in a blaze of glory. Lord, I never should.
Your crypto needs a wallet. And crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
Don't die Twitter versus Facebook. A rap battle. First up, Facebook. Twitter, I'll snuff you out like I did to MySpace. I'ma have to erase your little Twitter face. Warm it up, Facebook, I'm about to. Did they make an Oscar-nominated movie about you? Check my school out, I'm at the top of my class. My main interest is listed as kicking your ass. I help dictators get thrown over. You help the cast of Jersey Shore get overexposure, I'm too Titanic for you Twitter and twist. You bird-ass tweets, stick to the branches. I'm root deep, universal expansive. Twitter better get lost before you get poked. What? What?
Yeah, this is Twitter. Check it. At Facebook, can I attack you? Yes, and I could do it in 140 characters or less. Brevity's the soul of wit. I'll make this quick. Hash mark. Facebook is a dick.
Retweet.
Yeah, I'm backing that ass, and I'm young and I'm brash, and I'm packing that cash. Stick with the kid, I'm an early adapter. Your old Facebook played out like Napster. I make it real easy for family to talk. I make ex-girlfriends real easy to stalk. I show you life in real time that's completely amazing. I show you which celebrities are totally crazy. From Blitzer to Sheen to Kanye to Rom. I run with stars, Facebook is a place for your mom. What's the matter, Zuckerberg? Don't like how that sounds? I got 1 million customizable backgrounds.
You're so totally boring.
My card's on the table, hash mark. Facebook is disabled.
So I've been trading for about 5 years, maybe 8 to 5 years, and I got in the options world because I wasn't making enough with just holding long equity. You know, there's not a lot of strategy. It's just sort of like buy it and then pray it goes up. I found tastylive from my friend, and I started looking at the YouTube videos. My favorite part about it was just that there was math, there was probability, it was something you could consistently rely on. Once someone gets the right information, which they provide on tastylive, they can really change their financial situation for the better. Consistently, not, oh, I bought a stock and it went way up one time, but how can you do it consistently, over and over? And with tastylive, I was able to do that.
Rewatched that market measures from this morning, Bodacia. Our raid really distracted me. I was like, get away from me, uncontrollable fire.
I told you, Tasty Grax, you can't plunder with headphones on. Light pillaging, maybe.
Sometimes I'll hide in a gross peat bog in the middle of a raid, just so I don't miss market measures.
I'm only recently comfortable admitting this, but I think I trust market measures more than I trust my savage hellhorse, Arbitrageur.
God, I forgot to tell you guys that I slaughtered a horde of conformerons this morning. Did the whole terrifying row of severed heads on pikes as a warning thing, but you never know with those idiots.
Okay, thanks for the heads up.
Ha ha ha! Goblets of hot blood for everyone.
Nice.
Thanks, you guys.
Normally I hate puns, but that one was okay.
In the world of options, somebody once said, for every gimme, there's a gotcha.
It's all about generating positive expectancy in your portfolio.
Welcome to Option Trades today. I'm Tony the Bat Batiste, and I've got not one, but two trade ideas for you today.
Exploring Zero DTE. We promised you we would take a look, and here we go.
Well, we're through the Fed, and we've had a day to digest it and think about it, and the markets are nowhere. Apparently, we don't know what to do and what to make of what's going on, but we're going to try to figure it out here and see if the markets really are through whatever consternation struck them over the preceding 4 weeks, or if there is still trouble ahead. This is Macro Money. I'm Ilyas Spivak, head of Global Macro at tastylive. And what we are going to start with here, first and foremost, is, of course, identify what it was that the Fed did and didn't do, what the tone was, why the markets initially reacted the way that they did, and then see if this lack of conviction tells us anything in the aftermath. So let's break this down. We're looking here at the Fed policy statement, and you can see the revisions highlighted on it, and you can very clearly catch it's that second paragraph where all of the action is. Now, much is being made about the changes in QT, the runoff in the Fed's balance sheet, but we'll get there in a second. The meat of what the markets seemingly reacted to is that second paragraph revision. So you'll notice that before, the committee thought that risks to achieving its employment and inflation goals were roughly in balance. Now, uncertainty around the economic outlook has increased, and the committee is attentive to the risks to both sides of the mandate. Now, ostensibly, this is exactly what the markets wanted to hear. They wanted to feel seen. They wanted for the markets sell-off to be noticed by policy officials. And the conversation that was being had from the White House against the backdrop of the sell-off was, yeah, we really don't care. This is fine. The economy needs to adjust and, quote-unquote, detox. It's unclear what it needs to detox from, but the message was, look, this is not anything to be concerned about. The underlying economy is healthy. This is just a lot of new policy happening all at once. The markets will adjust. What the markets saw was, as we discussed earlier on the show this week, not so much that the policy was untoward. They knew what the policy direction was going to be as early as November and maybe even before. But certainly once it was clear that it would be a Trump administration that would be taking office in 2025, the markets very clearly knew that there would be tariffs, that there would be cuts to fiscal spending, that those cuts to spending might be balanced by, at the very least, making the first Trump term's tax cuts permanent. And so there would be a generally understood policy trajectory. It's not until survey data on business confidence and consumer confidence, in particular the S&P Global PMI surveys in early February, that began to show that the implementation of the policies is starting to impact confidence. Not the direction, but the seemingly volatile implementation of the policy that's starting to impact sentiment. And what that sentiment is doing is it's pushing people to withhold spending, pushing businesses to withhold investment, and that is significantly eroding confidence and undermining activity, especially in the service sector. And so what the markets wanted as they reacted to this over the past 4 weeks was some sort of a reaction function from officials, where the markets fall, officials go, oh, well, that's not good. Let's calibrate our approach. Not necessarily, again, in terms of direction of policy, but implementation, or at least communication with the markets. And the message from the administration was, everything is fine, we don't need to calibrate, moving on. The markets then turn to the Fed and say, well, surely if something were to go wrong in this implementation, you would backstop us with lower rates by cutting borrowing costs sooner. And if you're going to do that, we're going to need for you to signal that you're seeing what we're seeing here. And this passage seems to indicate exactly that. Now, as far as the summary of economic projections, the other big sort of numerical forecasting tool here, we can see the Fed lowers its GDP expectations, which, again, seem to acknowledge the market's concerns. They also increase inflation expectations, which seem to acknowledge consumers' concerns. The latest survey on consumer confidence from the University of Michigan put one-year inflation expectations back to 4.9%, which is the highest since the second half of 2022, just as the Fed was starting to really have impact on bringing inflation lower, having, of course, initiated a blistering rate hike cycle in March of that year. So the Fed is seemingly saying to the markets here, okay, we can see that there is a risk that growth is going to be weaker, and we're going to acknowledge that. We can see that there is a risk that inflation is going to be higher, and we're going to acknowledge that. This pulls policy in different directions, so we're not going to change course on the actual expectations for Fed funds. And of course, as Fed Chair Powell began to speak at the press conference after the meeting, the caveat there is we're not going to adjust it for now. And this probably gave the markets some confidence in being seen as well. And we'll go through what Powell said here. It's been nicely categorized by the fine folks at Forex Live. Had tipped to them. Here are the highlights. So on rates, I mean, the clear sort of bottom line here is the Fed does not feel that they are in a hurry to move now. And we can see that it's not so much that they're reluctant. They're saying they can move in either direction. It's that they are waiting for clarity, and they don't think that waiting is a high-cost proposition. They feel confident that they don't need to be in a hurry. They can wait. And of course, they're acknowledging here that if the Fed's goals need to be balanced against each other, that is to say, weaker growth, higher inflation, that would be difficult, but they're not currently seeing that in practice. On the spiciest topic of the bunch, tariffs and inflation, the Fed, of course, acknowledges that tariffs tend to bring down growth and tend to bring inflation up. Of course, the forecasts reflect exactly that. But what they're saying is that it's too soon to say if it will be appropriate to look through these effects. And of course, we've heard these comments from the administration saying that what a tariff is a one-time price adjustment. And that one-time price adjustment will work its way through the economy once it's made, and that's it. Businesses will, as a one-off, adjust to a new level, and on we go. That's not necessarily wrong or right. It's a cogent theory, but when you put tariffs on input goods, for example, like aluminum and steel, that other industries rely on, there can be vast ripple effects, and those ripple effects can be sticky. So, for example, if you are a maker of steel and there are tariffs on steel, well, then you're happy because the price of steel from your imported competition has gone up, and that opens more markets for you to sell steel, at least domestically. But if you are a buyer of steel, let's say you make nails, let's say you make appliances, cars. If you are a buyer of steel, then you now face a higher input cost structure. And that means that you're assuming you're passing that on, of course, as most businesses would be, at least to some extent. Now you have a general rise in the price level for whatever it is that you're selling, for which steel is an input. And everybody that buys that thing from you now has their cost structure go up. So even though you might not be applying a tariff directly, let's say, to appliances, in applying one to steel, you are. To appliances and cars and home fixtures and nails and whatever else. So it's unclear what ultimately the net effects look like, and that's exactly what the Fed is saying here. A telling quote here is Powell says, "I'm not dismissing that short-term inflation expectations are rising, but long-term expectations are still anchored, and that's what we're going to watch." So wait-and-see mode yet. But again, an acknowledgement of the source of the market's worry. On the economic outlook, again, acknowledgement. Sentiment has fallen off, but the economy is healthy. And this seems to be the real key going forward here. If soft data becomes hard data, we will know very quickly. The upshot being, if the pain and mayhem that now appears in this sentiment data, like PMIs, like consumer confidence data, starts to show up in employment and inflation and so forth, well, then the Fed will be ready to pull the trigger on rate cuts without delay. So we see all of this, and the bit on the balance sheet is interesting because the Fed says that what got them thinking about reducing the runoff in the balance sheet wasn't a particular desire to ease policy. It was flows in and out of the Treasury general account, which reminds us that when the Fed makes money on these securities, it puts the proceeds back into Treasury because the Fed isn't financed by taxpayer money. It finances itself through its own operations. And essentially what Powell is saying here is that they would like less turnover in their Treasury security holdings coming in and out of the Treasury general account because the markets are uncertain and bond prices are jumping all over the place. So the Fed doesn't want basically their P&L with the Treasury to be volatile. So they are going to move at a pace that's slower. We'll notice that what the Fed doesn't do here is make any changes to its pacing for mortgage-backed and agency debt, just the Treasury side of things. And this probably speaks to their perspective that monetary policy expectations are likely to remain volatile. So the market ostensibly feels seen and gets that bit from the Fed that it wants to hear, that the Fed is mindful and that the Fed sees what they see. And the response is encouraging. Stocks go up. The upshot is that whatever the Fed said was dovish. Yields come in. The yen, a creature of yields, mostly, goes up, as it tends to do when yields decline. Bitcoin confirms the risk on tone. Gold, interestingly, doesn't make a big move, but it had been rallying going into this, so perhaps it just ran out of immediate conviction, having already gone up a lot. But one would think that gold would be better supported in an environment where you have this kind of a situation. And the euro, interestingly, is down, but look under the surface and it's down much less than it had been earlier. The decline going into the Fed was almost 0.8%, and ultimately the euro finishes down only 0.3%, and all of that reclaiming of lost ground comes after the Fed. So the dollar weakens on net. Now, of course, the markets are concerned and have this need for acknowledgement because there has, in fact, been a downturn in the economic data that is worrying. And this is the Atlanta Fed's GDP Now tracker for the first quarter GDP number. What this is a nowcast, so it takes incoming economic data as it appears, dumps it into the model, and the further you go in time, the closer you get to the actual number, the more data and the more relevant inputs you have, so the closer the forecast is to what the actual number is likely to be. Whether or not the economy actually shrinks at an annualized rate of 2% in the first quarter ultimately is not what's important here. There's no way to know that ahead of time, and although that looks dramatic, who's to say? What's important is the direction of travel for the model, because what it tells us is the tone of the incoming data that's been dumped into it. And clearly, everything that's been coming out, basically since late February, has been painting a very grim picture, which is why the model looks the way it does. So the markets are concerned because, indeed, the data is telling them to be concerned. And, of course, the first piece of this data has been the S&P Global PMI numbers that show over the course of January and February a steep drop in the manufacturing or in the service sector, even as manufacturing claws back a little bit. Commentary from S&P Global in doing these surveys has been, it is uncertainty about fiscal policy and trade policy in particular that's driving negativity in the services sector, which is interesting, of course, because trade policy mainly concerns the goods side of things. So this is a very pure sentiment sort of indicator where the economy's largest sector is more concerned with the optics of the policy and how it's being implemented and what they're extrapolating from the management's style than really from those things hitting services directly because the price of this or that input has gone up because of a tariff. So that's, of course, very telling of general sentiment in the business community. For the manufacturing side, there has been a little bit of a move higher. We're north of the 50 boom-bust level where the sector is expanding, and in fact, it's now expanding at a faster rate than is than is services or the overall composite, which tends to follow overall services because, of course, it's a much bigger sector of the economy than manufacturing is. But the commentary on that is this is mainly front-running of the tariffs. So stocking up on things before the price goes up. And that's where you get all this extra manufacturing activity, which makes the upswell necessarily a temporary thing. Moreover, this doesn't just scream that there's a problem in the U.S., but when we look at the drivers of global GDP growth, we of course see that the U.S. is the biggest overall piece at 26%, but moreover, the entire pie is 58% just three economies, the U.S., the Eurozone, and China. And those are the main drivers of demand. Most of the rest of the world, 42%, are vendors to the large three. So obviously in the U.S., we're thinking Canada, Mexico. In the Eurozone, Central Europe, Nordic Europe. In China, we're thinking Australia, New Zealand, the commodity producers of South America and Southeast Asia and Africa. So a lot of what's there in that 42% needs demand from China, the Eurozone, or the US in order to have contributing demand of their own. And so this is really why the US slowdown is such a problem. Going all the way back to the middle of last year, the Eurozone and China are already on a slowing path. It's the US that's holding up global growth. And the first 2 months of this year, what you get is the very wrong kind of convergence. Weakening US activity coming down to the standstill-like setting that we see in Europe and in China. How you don't get a global recession in this environment seems difficult to imagine. In fact, we can see that all through last year, overall global PMI numbers from about mid-year are slowing, which reflects exactly this. The U.S. is powering higher, but it isn't pulling the rest of the world along because the other two engines are off, and what is actually getting powered in the U.S. is the service sector, which is mainly serviced by domestic firms. Imports, exports, where U.S. demand might extend to other countries because they're selling to a robust U.S. consumer, that's the good side mainly. And that's why the overall global total has been moving ever closer to ever slower settings over the course of basically the second half of last year going into this year. And of course, the situation has only become exacerbated here at the start of the year with the U.S. looking weaker. First thing Monday, there's an opportunity for this trend to be reasserted because we're going to get the March updates of these PMIs. And of course, we're going to be looking at the U.S. numbers most closely. The expectations here already that we're going to get weakening to near standstill on the composite as services contract. The numbers out of the UK looking like maybe they'll be a little bit warmer. The numbers out of the Eurozone looking like they're going to be, again, flat. We're not going to get updates from China until later in the week and the following week. And if you look at what's going on in Australia and Japan, it's about a scratch there. So the real issue, of course, the U.S. numbers, and that we're expecting this slowdown. Moreover, U.S. economic data has been tending to disappoint relative to expectations, eyeing this Citigroup data. So we could get a reminder of exactly the risk of recession that the markets have been so worried about as soon as Monday. And the real question will be, do the markets shrug that off because it's not, quote unquote, hard data? Or do we finally see this consolidation post-Fed resolve? Is it going to resolve to lower stocks? Any which way it go, it seems likely to resolve to higher bonds and a weaker dollar as more easing enters into the longer end of the forecast. And that is macro money for today and for this week. We are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Macro money will be back next week, as it always is, Monday through Thursday. I'm likewise on with Chris for Futures Power Hour Mondays and Fridays. That's coming up tomorrow. On with Victor Jones for The Price of Truth on Tuesdays. On with Victor and Tom for First Call on Sundays. Check that out at the start of the week. Writing for the News and Insights portion of tastylive.com. Commenting at Ilias Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Take care.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Woof! The first half of this year's market has been giving the good guys the business.
It's certainly been back and forth for sure, Pete, and I'm getting whiplash over here.
With good mechanics, we can see Team Tasty stay strong in the second half.
Absolutely. Let's check out our starting lineup.
Liz Deerking, Eastern Illinois University. #1, because dedication and motivation equals success. Being able to make that one trade that builds on the next is the very first step.
Matt Helmuth, Illinois State University, #30, because that's how many of Tom's credit card purchases I have to decline a week. Stop trying to buy a suckling pig online, Tom.
Bobby Shepard, School of the Art Institute of Chicago. Number 6, because that's how many revisions every piece of copy goes through.
Jenny Andrews, University of Illinois Urbana-Champaign. Number 18, because that's the average of the VIX over the last 10 years, and I cannot wait for it to get back there.
I like the looks of that lineup.
Well, be mechanical is always better than just trying to run plays and see what sticks, Pete.
When you got skin in the game, you stay in the game.
That's right. Now get off the couch and get into the game.
Watch Tasty Trade.
It was a great show, very inspirational and motivating.
I feel like you got to know each of the traders a lot better on a personal level. It was awesome.
This is my 10th or 11th live event. I thought the math was really complicated and it wasn't, and then it just made sense.
They've opened my eyes to many different strategies.
And I realized there's a reasoning and strategic planning that you could do to be successful. I love all you guys.
How much does it cost you guys to do simultaneous hair flips?
Years of practice.
Everybody wanna be like me, yeah.
We built Tasty Trade for today's traders. See it, click it, trade it. Customized charts with hundreds of indicators. Actually see your potential profit and loss. Quickly roll to the next expiration. See gains and losses even when you roll. Cancel, replace, duplicate, or invert orders with just a few clicks. The tools, the data, the knowledge. See it, click it, trade it. Join the club, genius. Tasty Trade.
What's going on, guys? Welcome back to the segment. We're back today with Luis, my brother. How we doing? What's going on, chat? I hope everybody's had a great day. Today, we're going to go and do a little tour to market, check out some of these positions. We put on some positions yesterday with Dr. Jim, so we'll check all of that out. But Luis, brother, so good to see you. How we been?
Been great, man. It's great to be here with you, with my brother from another mother. I'm excited. A lot has happened. You know me, leaning more bearish always. 2024 wasn't the best year, but this year, at least, finally, man, the bull market more than 2 years. So yeah. I'm very excited to be here with you. Excited to hear positions. Happy to hear on Tasty Trade again. So I'm excited to see what's happening on with your positions.
Yeah, absolutely. We'll get into all of that here in a moment. I know a lot has changed. The market, a complete different market environment than I think last time we spoke and we hopped on here. I think you're on the 4th or 5th kid now, something like that. Give us an update, brother. How we doing? What's new with Luis?
No, not even married, man. You are the one.
Come on,
I've seen your stories on Instagram. I've seen you're deeply in love, man. And
I don't know what you're talking about, but I see yours. You don't. I keep up with you, brother. I keep up with you. But how's the weather over there right now? What's new? You've been paying attention to the market. Anything else? What's been going on with you?
Yeah. Trading a lot lately. I actually changed a little bit of my methodology. Now I'm leaning more to cover calls lately, which I've actually paid. Long China. Julia and I discussed it a lot last year about the Chinese stocks, also Alibaba especially.
Yeah.
And with all the stimulus from China, I don't know if you've been trading them or someone bought them. Alibaba, JD, Baidu, PDD. All those have been amazing. I've been applying a little bit of cover calls, a little bit on the cheaper ones like KWeb, FXI, JD.
Yeah.
Cheaper ones because Alibaba is now a little bit more expensive. But today they got a little bit of a pullback, maybe for a. I don't know. I saw Tim Knight earlier on today talking about FXI, about a possible pullback. That got me a little bit worried because he's the best bear out there. I really follow him. So look at that. It's looking a little bit toppy, honestly, FXI. So I'm honestly still going to hold my positions long China. I'm right now on the April contracts. I've been doing some covered calls, but overall, China is the 5th best ETF FXI in the world. I was surprised when I actually saw the top ETFs in the world. Poland was number 1. I think Greece.
Which one was that?
Poland.
Okay.
I don't even know that ticker for the ETF. Greece was second, but who trades that stuff? China at least is way more liquid. It has ADR. So yeah, those, and I shorted a lot those quantum computing stocks. I don't know if you've been trading them. Have you traded computing stocks?
No, I mean, I know they were really popping off. It almost felt like it was a mini like quantum computing bubble for a little bit. Not too much. You said you've been kind of short a little bit those into this new year.
Yeah, I started shorting them a little bit since December, especially IONQ a little bit more. Well, I started with QUBT, but today it was a quantum computing day from NVIDIA. I don't know if you saw it. Jensen Huang actually said to the panel, he invited the top CEOs of quantum stocks from IONQ, also Argeti, some of those names, and he actually said that he didn't knew that these quantum computing stocks actually were public traded companies. So you can imagine what happened with those. IONQ dropped like 10%, but I've actually dropped a little bit off from those quantum. I think they already crushed them a little bit. I won't be chasing down any further the short. But look at that. It actually went from like $5 to like 60 in a few weeks. But yeah, now focus more in China. And honestly, I don't know. Tomorrow's going to be a big day. Are you prepared for tomorrow? It seems like the quad witching day.
Witching.
Yeah, it's expected.
I know there's
to be
a lot of
day,
yeah, I know there's a lot of option contracts expiring tomorrow, so that's going to be interesting. Before we do shift gears here, I'm curious. You've been looking at Carvana at all? I know you're like the Carvana ambassador. It kind of feels like. What's been going on over there?
Carvana was my biggest loser last year. Actually, really? This year I shorted the stock.
Right.
I actually decided to short it again once I saw those earnings. Once I saw the Hindenburg research report about a possible fraud. If nobody has seen the Hindenburg research report on X, it's worthwhile. They actually say big thread about how they might be doing some bad stuff. That's not 100% sure. I don't know, but started shorting there. Also, Amazon said yesterday that they will be likely entering the used vehicle market. So they'll definitely be competing against Carvana. And honestly, I'm the investor, but for the short side. I don't like Carvana. That stock went from like $3 to $280 in 2 years. I'm not sure right now, but I'm definitely planning on entering again. I shorted this year. It's not my top performing stock, but definitely recovered most of the losses from last year. Because last year I decided to focus way much on my opinion rather to what the market was saying, and it's not looking pretty well for Carvana. It's had an amazing rally, and I honestly still think that it has more room to the downside because it has a lot of pressure. Earnings were actually pretty bad. The first time they actually had lower revenue than expected in the past 2 years, which still they've had an amazing run up. Competition is ramping up. Also, I don't know if you saw, but a warning sign that the default rates on automobile loans is actually skyrocketing right now. So that's definitely not good for Carvana.
Yeah, no, definitely. One thing that you mentioned was Amazon getting into that space. That's one thing I won't underestimate Amazon on, because one thing that did surprise me was Amazon Prime Video. Like, I know Amazon, there was a lot of pushback. I think even with Jeff Bezos, when he first wanted to get into the video space, putting kind of like the Netflix style log with the movies and things like that. I didn't even think Prime Video would catch on too much, but they're killing it. And that's one thing where I won't underestimate Prime. So if Amazon gets into the space like Carvana, I think they just have the brand, the awareness, and the capital to really destroy any industry that they choose to get into. So that's one thing I won't put past Amazon. But in terms of that, what was the recent ticker you had just mentioned before that?
For the quantum one?
Oh yeah, I think you were talking about IONQ.
IONQ, yeah, that one.
IONQ. I mean, speaking for Carvana, this kind of seemed like it was. I mean, there was a lot of good news with Carvana. I think this was exciting. I mean, the vending machine style vehicles, all those kind of things. But I mean, this had an insane rally over the last 2 years. So this is one I'll keep an eye on from probably more shorts. Like maybe if we get some type of ramp up to the upside, might look to maybe sell some out of the money calls. But I'd probably be on the same side of you, be a little bit bearish on that one. But IONQ, I know you mentioned too, kind of looks like this short-term bubbles is kind of popping over here. And what's going on, Lone? Reporting live from Costco. Check out Costco actually here in a little bit. I think the hot dogs are still at $1.50. But no, this quantum computing even bubble is kind of bursted. But I think Julia got me really interested in the quantum. That's a tongue twister. Like the quantum computing space and those computers, right? Not something that the average individual is going to have that type of computer. But I mean, when it comes down to Bitcoin or like mining Bitcoin, I am curious to see like how more efficient using a quantum computer could be when it comes to mining Bitcoin. So that's been on top of mind too.
I don't know about mining Bitcoin, but let me tell you this. They actually had, I saw on the news a lot of hype about IONQ today because they reported today that they actually are, their production system shows 12% faster performance over the classical computing alternatives. Like they're spending millions of dollars, hundreds of millions of dollars. They're called quantum. They're actually saying they got all these breakthroughs and they're only 12% better than normal computers. Like I think that actually did not disappoint. That actually helped the stock in the morning. The thing that disappointed today was Jensen Huang's comments on the computing, quantum computing stocks a little bit. Mm-hmm. He actually apologized to them because just in January he actually pushed them lower after saying that he sees quantum computing to be available in at least 15 to 20 years. So he actually apologized today about that. He still was surprised that they are actually publicly traded. I don't know that that's definitely not a good signal for them. The stocks drop. But for example, IONQ, I don't know about that's a really good question for how faster they are mining Bitcoin. They actually just came today saying that they're 12% faster than a normal computer, which I don't know. I'm not very impressed with 12%. Neither the market was. I mean,
for the price, for the price and the accessibility of these computers, I would have thought 12%. It would have been a larger gap than that. I mean, for the price and the accessibility of these things, so I would agree there.
Yeah, for sure. But maybe I'll definitely be entering more if it breaks the 20 mark to short. Has a 50 from all the quantum. I think IONQ is definitely the best one based on numbers. It's definitely the one that has actually resisted the most because other ones are actually on the single digits, very low single digits. But for example, it has a 50 million revenue over the past year, and it has a market cap of 5 billion.
Yeah.
Versus a 50 million revenue. Net income is actually way negative, so they're losing a lot of money. They're burning through cash very fast. And I will not be surprised if they start issuing a lot of shares to actually get cash and be there for longer, which that actually be diluting existing shareholders. And I don't think the market will actually take it. Otherwise, even though it's actually, I think, already priced in, I don't think it's not going to be the best news. But yeah, I've been trading those really heavily, especially at the beginning of the year. But I don't know, what are your thoughts on IONQ?
Again, with the quantum computing, I've kind of just been looking at the bubble just burst in there in terms of that. I mean, I'm bullish long term. You know, the 12%, again, would have thought the gap would have been wider, especially with the accessibility of those products, the price, all those kind of things. But I think long term, I'm definitely bullish. When it comes down to development and technology, I'm typically bullish. And it's kind of funny because I know I've talked about my skepticism around like the auto driving, right? I know over the last couple of weeks, Gus and I, Dr. Jim and I, we've been touching a little bit more on like the robo taxis, the self-driving cars, and I've been really skeptical about it in terms of like when is this going to see mass adoption? But overall though, I'm bullish on development and technology. I think it's only going to keep speeding up, and I mean, it's kind of ironic because quantum computing helps speeds things up too. So I'm bullish. That's one of the reasons why I'm bullish on quantum computing. Go ahead. You had something to say?
I'll be buying, definitely. That's a great point. I'll be bullish on the full self-driving and all that vehicle stuff. Once I see a Tesla or whatever car it is, a BYD driving full autonomously in Mexico streets. Mexican streets.
Hey, you let me know when that happens, and so we can know what to do over here, Luis. So give us a heads up.
Yeah, for sure. Because Mexican streets, man, oh my God, they're nothing compared to the U.S. streets or highways.
Yeah. I hear you. I mean, speaking of Teslas, these are some of the positions that we have on right now. Meta, as you know, with the continued down moves we've been seeing in the market. I mean, it's a better day today. But Meta, we sold an out of the money put spread on Meta. This one's 28 days till expiration. Gonna have to manage this one by next week. We got QQQ on out of the money put spread. We sold on there. We'll see what happens by next week and have to manage that one too. Tesla, down a little bit on Tesla, but Tesla's a really volatile underlying. So this can flip in a matter of a day or two. So still have some more time on that. By next week, when it comes down to managing that one, I'm going to have to decide on if I want to maybe roll that, add more time, or if I just want to take the position off, redeploy the capital elsewhere. That's kind of where my head's at right now. And then we got USO. I don't know. Have you ever traded a zebra before? So we put on a 0 extrinsic back ratio yesterday with Dr. Jim, and it's working out pretty well so far. We wanted to get a little bit of long exposure in the oil market, and I typically like to use USO to do that. And it's pretty much a synthetic stock position, right? So it's almost like being long a synthetic 100 shares in the underlying, but using options and not having to worry about that theta decay. So that's working out really well today because USO is up on the day. Up about 160 on that because the underlying's up about $1.34. So that one's working out really well today. But have you put on a zebra before?
I actually have not.
Yeah. Here, check this out real quick. So this one was actually pioneered by Liz and Jenny, if I'm not mistaken. So if anybody wants to see more details about that, they got a lot of videos on YouTube breaking it down. Excuse me. But what we do is we sell an at the money call. If we want to be bullish, we sell an at the money call, and then we buy 2 of the 70 delta calls that are a little bit more in the money, and then that should bring us near 0 extrinsic value on our contracts, and then it should bring us very close to being long 100 deltas. So again, day by day, I'm not affected by time decay, but I do need this one to move. I do need this one to move in my favor before expiration, or I could potentially lose the debit that I paid for this position. And I think I paid maybe $7.13. I think I had paid for it, but it's kind of cool too because it is a synthetic. Because it is the synthetic stock position, we could also use this as like a synthetic covered call position because we can also sell calls, right? Because it's a synthetic stock position. We can sell calls against that as well if we want to hedge. So that's something I could do too if we keep rallying to the upside. I mean, maybe I could even look at selling one of these calls over here, collect an extra 75 cents of credit. That's not in the plans right now, but that's something that you could potentially do in that. But USO has been working out really well right now. Just wanted to get some long delta in oil. Not something I typically trade, but I don't know what your thoughts are on oil overall, Luis.
I haven't actually seen it lately, but that looks to be working pretty nicely. I've heard about some stuff about with Israel and the conflicts again, the geopolitical stuff happening once again. So kicking up a little bit higher oil. Obviously, you want to see conflicts with that, but seems like it's actually, from what I've seen, I haven't actually even traded this year oil, but look at that consolidation. Might actually looks good. It's been holding steadily around 66 even since December of last year. So you might actually be in for a nice bump to the upside on oil.
Oil was one of those underlyings that I was never too fond of. It was one of those that it can get pretty hot in the kitchen real quick. Like oil was one of those underlyings. And I think the more you trade a specific underlying, you get a feel for its personality. And I wasn't really vibing with oil like that before, but if I can do some defined risk positions on it, I'll take part in that. I was even looking at /MCO, right? The micros on oil, but just due to the nature of oil and the tendencies that it has, it's so heavily affected, especially by news that kind of talk about supply and demand when it comes down to barrels of oil or whatever it might be. I've noticed it's very sensitive. I never know how to.
I actually seen those reports and the USO inventory barrels, they come in lower than expected. It's bullish or bearish. It's very hard to actually interpret those data. Honestly, that's why last year I traded a little bit of CL, but I got caught in a lot of big moves. So overall, I stayed away a little bit from oil.
No, I hear you. I'm very fortunate on this move today in USO because, of course, this is what's nice. I put the long position on in USO yesterday, and we have an absolute rip to the upside. So That's nice. But again, I think USO, the premium wasn't too attractive. That's why I didn't end up selling an out of the money put spread. It's usually the go-to whenever wanting to get directional and an underlying, but I ended up going with the zero extrinsic back ratio. It's paying off so far today. So maybe I hold this one for a swing. I could even hold this one even a little longer. And if I want, I could just exit the position at break even because it is a very directional trade. It's only direction that I'm trading. And because I'm so a little bit more in the money because of the big move that we've gotten today, I could just set my stop loss at break even. But that's another thing to keep in mind because it is a straight directional play. You do have to decide on how you want to manage your risk on things like that if things go south. But that's the only most, I guess, position that I'm fond of in the portfolio right now, Luis. I don't know what else you've been looking at.
What made you actually enter a little bit long on Tesla? Matt, I actually understand, but Tesla, well, maybe the fact that it's down 50%.
Because exactly. I mean, Tesla's been getting hammered. I mean, I think most underlyings in the market has been getting hammered. But I mean, if you really look at Tesla, I mean, Tesla has taken an absolute beating, right? I mean, Tesla's going to be more attractive around the $200 level. I don't even think Tesla at 200 is that far fetched. But I mean, we were trading at a high of what, 487 just back in November, the end of November, almost December. That was just about 3-4 months ago. This has pretty much almost been chopped in half. So that's one of the reasons why I wanted to get long here. The premium was pretty solid. I'm not one to trade Tesla either, but when it's at these levels in such a short amount of time, it just looked attractive at that point. So maybe if we start trading above this 200 SMA, then I'm going to be a little bit more comfortable in the position. But from now, I'm going to have to manage by next week. But we really haven't gone anywhere in terms of my personal position on it. You're not allowed to trade Tesla, though, right? I remember that.
Well, sorry?
You're not allowed to trade Tesla. I remember that.
Oh, no, I'm not allowed. But actually, I've traded Tesla this year. I shorted Tesla this year, and it's actually my worst performing stock on my portfolio. I went short heavily a little bit like around February. When it actually broke the 400, I was bearish. It actually recovered to like 430, around that mark when it went like around 390. I entered short at 390. I remember it was a CPI report from January that actually just to make the market go higher. Tesla went from like 390 to 430 in the same day. I got spooked, closed my entire position. The following day just reversed backward, and I actually haven't traded Tesla once again. But it's amazing.
Honestly, was that a shares position?
Yeah, shares position. It took like 30 shares. Well, actually, ended up having 50 shares short. You know me a little bit. Sometimes I like to take shares.
You're the reason why Tesla's tanking. This man buying 50 shares of Tesla at these levels.
I lost money on Tesla. I did not hold it. I was actually thinking I'd actually retest again the 52-week high. Well, it's not the 52-week high. It's actually the ultimate high, 487, I think. But the Trump bump, adios, no more. No more for the Trump bump.
Yeah. I think it was Dr. Jim the other day. He had mentioned, or was it Gus? It was one of the two. They had mentioned, I mean, Tesla went on an insane rally, right? Especially heading up to the election, especially post-election. But a lot of these stocks are taking a massive hit right now. And it's almost like Tesla was able to get a head start on the hit that the market's taking right now. Because if Tesla didn't have that massive move almost up to $500, I mean, Tesla would have been sitting at a lower price right now. Maybe we would have been sitting at 200 if that wasn't the case. But yeah, it looks like the hype is over right now. Things are correcting to where they should be. I mean, we're on the weekly chart right now, and this doesn't even look natural. I mean, again, we were trading at 244 on Tesla 1, 2, 3, 4, 5, 6, 7, 8 weeks later. I mean, we're trading at almost 500. This is like meme stock territory almost. But that's what you got on Tesla, Luis.
I might actually enter long Tesla, given the fact that it actually made higher lows this week than compared to last week. Again, today managed to be barely green, even though it was a wild day. Difficult to trade these days with such a
this entire week
on the market.
What were your thoughts on the market Monday, Tuesday? That was some of the choppiest price action I think I've ever seen in the last 5-6 years looking at the market.
You know, I'm happy that I've been able to actually be profitable for the week, but I've been, for example, today I actually entered some longs. Out of nowhere, I actually gave all of my gains right away. Managed to be barely positive on the day on the MES contracts, but it's been hard. It also, I think they've been selling all of the major move higher. It's like an H, you know, it's basically looking like an H rather than like the V-shaped recovery. As I've actually steered away from the micro Nasdaqs. You introduced me to those ones. I love them, but oh my god, yeah.
The Nasdaq is a little bit more volatile for sure.
Yes, that's why I definitely prefer the MES.
Yeah, I like to refer to it as like very wicky. Like you can get a lot of wick. I mean, case in point here. I mean, you can see this massive wick on the bottom of this candle, and then we reverse massive wick down here. These aren't even the bodies of the candle. And I know if we kind of compare that to ES is a little bit slower moving. And I think, the range that ES trades is a little bit smaller, but the point multiplier is a lot higher on ES than it is on NASDAQ. So it makes up for it. So NASDAQ and ES kind of has its own personality, and it's really just up to whatever you prefer or are more comfortable with. But I definitely hear you on the NASDAQ. It's a lot more wicky. That's how I usually describe it.
For sure. I hate when I open a position and right away I'm $50 down because a candle on the 1 minute was a $25 movement right away. So personally, for my sake, I rather enter 2 contracts on ES, MES that basically is just like one MNQ on the MES from what it moves likely. But still, I like it better. I've done way better trading just 1 or 2 MES contracts. If I go high, maybe I'll take 3, but no more than 3 personally for MES contracts. And the movement is, way smoother.
No, I hear you. This was the price before we wrap up here. This was a price action on Tuesday. We had that initial sell-off in the morning, and then we chopped around in this range all day. Really nothing to do. Again, not too much of a surprise. This is a day heading before FOMC, but so not expecting too much of directional moves with that binary event to come. But that's what we had on Tuesday. Super choppy markets this week. Anything else to add, Luis, before we wrap up here?
I just want to ask you thoughts for tomorrow. I was seeing a report from Citi that $4.5 trillion are expected to actually expire tomorrow, the quad witching. Over the past 10 years, 7 have actually been green for the NASDAQ, but overall tends to be bearish over the past 20 years. So we were to say green or red tomorrow. What do you feel?
I'm gonna go. Hold on, let me zoom out real quick. Let me take a good look. I'm gonna go. I'm a little bearish, honestly. Even though some of the positions that I have on don't even though some of the positions that I have on don't reflect that, I would be a little bit more bearish. So that's what I'm going to lean tomorrow. The quadruple witching is tomorrow. So keep that on your guys' calendar. It could be a little volatile. And then also, we really haven't had much movement this week. So maybe we finally get a directional move in the market. Again, Monday was super choppy. Tuesday was choppy. We had some directional moves, but those moves were given back. Like after the FOMC, we ended up selling off overnight, giving all that move back. We ripped to the upside today, gave it all back by the afternoon. So we really haven't gone anywhere when we zoom out. But I'm going to go bearish. Where are you leaning?
I'll say also bearish, even though I'm also leaning long on my positions, even though in China, most of my positions. But I want to say bearish for tomorrow, and maybe we can scoop in some or buy the dip, because the dip just has been dipping.
Yep, the dip keeps dipping. That's how it is. And then you turn into a long-term investor. But Luis, my brother, so good to see you again, bro. I hope you're doing well. We'll have to catch up on some of these positions. Tell the kids I said hello, and we'll call up from there. But anyways, thanks for taking the time to hang out with us. We'll see how the market performs tomorrow. We got 1 day left. Tomorrow's quadruple witching, so something to be mindful of. And we'll catch you guys next time. Peace.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. Cboe is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, 2 female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the Cboe's SPX pit. Watch Liz and Jenny live from the Cboe, only on tastylive.
I'm like the Tupac of economists, going out on top. And will I ever really be gone? Say bye to Ben Bernanke. Cry your eyes out past the hanky. Gone from the Fed, but still looks swanky. Bye-bye, Chairman Ben Bernanke. Ben Bernanke, hardly knew ya. Ben Bernanke, Glad we're through here? Sayonara, Mr. Genki. Closing bell tolls for Bender Nanki. Now, say hello to Janet Yellen. New blood, maybe start some selling? All around the world like a market Magellan. Hello, Janet Yellen. Janet Yellen, Professor Shady. Janet Yellen, new chair lady. Welcome in the new Miss Yellen. Different from the old, there's no telling. And I'm out, like Tupac, in a peaceful transition.
People are always asking, where can they find my podcast? There it is, son. Look at that. Option Trades Today. You can listen here.
And everybody's waiting for my podcast tomorrow. Option Trades Today, every Tuesday and Thursday around noon. If you want to learn, sir, every Tuesdays and Thursday, Option Trades Today. You can find me on YouTube or wherever you find your podcast.
Option Trades Today. Are you listening to me? Option Trades Today comes out every day around noon, every Tuesday and Thursday. You too can stick with the bat.
All right. Perfect. I would like to buy Park Place.
No.
What?
There is no Park Place in this game.
Yes, there is. I'm looking at it.
No.
I
This
will
is mine.
take it.
It's mine. You don't get it.
Okay, alrighty.
You know what? $500. $500 to the electric company if you want to keep all of your power on all these houses and hotels. And
You can't negotiate. I landed on it. I can buy it if I want
I'm
it.
the electric company. I'm the most powerful thing here.
Excuse me, to the person who owns one property on Monopoly. This is the mayor, and I am overturning everything, and
You're
I am
in over
allowed
your
to
head.
buy. Excuse me?
You're in over your cute little head.
Don't patronize me.
You
This
don't
is a
come
board
down
game.
to where the big chimps play and expect to get a banana, sweetheart. You gotta earn it.
Okay, asshole. Give me my money back. Come on, let's keep
Whoa.
playing.
Whoa. Asshole. No, my father was an asshole. I'm king.
You are so wrong.
I'm very right.
Did you even take a wallet? Did you just eat my piece?
You don't have a piece now.
Seriously,
The
it's a
dog is
game.
gone. The dog is gone. You have nothing. I have a car.
Are you seriously pissed off because you're losing the game?
I'm not losing. I'm winning.
You are clearly losing. Look at the board game.
Every utility, 2 of the railroads, and what do you just have? You have a bunch of hotels and houses, which in this market is ridiculous. A nice, simple house on Mediterranean Avenue, a beautiful car worth 10 times more than your dog who is gone. Got to deal with me. Come on.
Okay, I quit. If you're gonna be an asshole, I quit.
Then I win. The old bait and switch. I got you. I told you I'd never lose this game. I've always got a plan. And you fell for it. Boom! Shalaka!
Welcome in Tasty CEO Tom Sosnoff, also found at Thinkorswim. Some call him the godfather of retail options trading. Tom, it's good to have you on. How would you be reacting as a startup founder to this news?
I'd be really pissed.
Yeah. As you should be, brother. I'm glad you said it because I can't.
And this is how we think as traders. You're much better off, instead of trying to follow the trend or follow the fundamentals, you're much better off playing the role of a contrarian.
And what I really want to do today is kind of break it out of that box and make it what it really should be, which is about understanding and thinking about probabilistic, predictable outcomes, about quantitative strategies. True financial literacy is about taking risk.
There's a very thin line between opportunity and risk, but where there's the most noise, there's the most opportunity.
The second you believe that somebody knows something and it's not you, then you're dead.
If you missed the live show, here's our cherry on top weekly recap.
You are making it seem I want to go.
I know you do. I know you do. Listen, there's a lot of things I want to do too.
I'll be the
night last night. I didn't have it in me. But back in the day, I could do it. I'm older now. You know.
Omaha.
Hold on, what did you want to do last night? I missed that.
Don't repeat that. No.
No, what did you want to do?
Do this every time I'm here.
I just want to know what he
Every time I'm
what did
here,
he say
we gotta
he
go down
wanted to
this
do?
road.
What did he say he wanted to do?
Do you need me? Do you want me to?
Because usually when he wants to do something, he just said, she says, go in the and do.
Here you go. Here's the. Yeah, get in the. See you later.
Nick is going to be sick.
The last 3 weeks I've been on this show on Wednesdays, it's gone down this rabbit hole.
Nikki's about to throw up.
What do you want me to do? I got 3 old guys talking about. Like, what do you want me to do?
Nikki's about to throw up.
The thought of you guys. It's like sickening. I'm sitting here like this. Like, it's hot as hell in here. I'm like sweating. Like, it smells.